This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hi everyone. Welcome back to the channel. Many Canadian covered call ETFs now use roughly 25% leverage. The reason is simple. Covered calls generate income, but they also limit some of the upside in a bull market. Adding a little leverage gives the fund more market exposure. That extra exposure can make up for some of the growth lost through option writing. So, during a bull market, a lightly leveraged covered call ETF may stay closer to its underlying asset. But what happens in a bear market? Can the option premiums offset the extra losses caused by leverage? Or does the fund take more of the downside while still missing part of the rebound? Bitcoin and strategy shares have both gone through major declines. So today, we'll use them to compare regular covered call funds with funds that add roughly 25% leverage. You can't predict the stock market. Nobody knows for sure whether stocks will go up or down tomorrow. But there is one thing you can lock in, which is free rewards from Moomoo. Right now, Moomoo Canada has a limited time promotion from June 1st to August 31st. When you open an account, you can get a 30-day free commission card, plus 30 days of 6% APY cash sweep. And when you make your first deposit, you can receive free stock rewards. Deposit 1,000 Canadian dollars and get 10 free shares. Deposit 8,000 Canadian dollars and get 30 free shares. You may even have a chance to receive popular stocks like SpaceX, Tesla, Nvidia, and more. Moomoo supports cash, margin, TFSA, and RRSP accounts, and it is regulated by CIRO with CIPF protection. Besides the welcome rewards, I also like that Moomoo lets you follow market-moving news in real time, and their ETF screener is very convenient for comparing ETFs. Interested? Use the link below this video to sign up and claim your rewards. Let's start with Bitcoin. We're comparing 4 products: IBIT, BCCC, BCCL, and HBIX. They may look similar on the chart, but they use very different strategies. IBIT is the simplest one. It gives investors exposure to Bitcoin without covered calls and without fund-level leverage. So we'll use it as our baseline. Next is BCCC from Global X. This fund owns Bitcoin-related assets and sells covered calls on part of its portfolio. But it does not use leverage. The call coverage can change over time. The usual limit is around 50% of the portfolio. At the end of June 2026, the actual average coverage was 40.91%. Then we have BCCL. Think of it as the leveraged version of BCCC. It follows a similar covered call strategy, but increases its total exposure to roughly 125%. Finally, we have HBIX from Harvest. It also combines an active covered call strategy with roughly 25% leverage. Now let's look at what happened. The chart starts near the end of April 2025 and runs through July 2026. IBIT fell about 30.35%. BCCC fell 40.99%. BCCL fell just over 50%. And HBIX fell about 51.47%. That may sound surprising. Many investors think that when the asset is falling, the option premium is basically free money. If the asset ends the period lower, giving up some upside may seem harmless. But bear markets don't move straight down. They fall, rebound, and then fall again. A covered call fund follows most of the decline, but it may not capture the full rebound. After several rounds of this, its price can fall further behind the underlying asset. That's why the premium is not free money. Investors receive income, but they give up part of the recovery in return even in bear markets. Of course, price return does not tell the whole story, because the covered call funds also paid cash distributions. If we add those cash payments back without reinvesting them, the results look much better. IBIT was down about 30.35%. HBIX was down about 26.07%. BCCC was down 21%. And BCCL was down about 25.61%. But we shouldn't read too much into this comparison. If an investor receives a distribution and keeps it in cash, that money is no longer exposed to the falling market. It's similar to gradually selling part of the investment during the decline. Someone holding IBIT could also have sold a small amount along the way and kept the proceeds in cash. So, for a fairer comparison, we need to assume that every distribution was reinvested. That keeps the full investment exposed to each fund's strategy. And this is where the result becomes much clearer. With distributions reinvested, IBIT lost about 30.35%. BCCC lost about 25.54%. BCCL lost about 32.23%. And HBIX lost about 33.7%. So the regular, unleveraged covered call fund did provide some protection. BCCC beat IBIT by almost 5 percentage points. But once 25% leverage was added, that advantage disappeared. Both BCCL and HBIX performed slightly worse than IBIT. The option premiums helped, but they were not enough to offset the extra downside from leverage, the cost of financing, and the upside lost during temporary rebounds. Now let's move to strategy, which was even more volatile. Here we're comparing MSTR, MSTY, and MSTE. MSTR is not an ETF. It's a Canadian dollar hedged CDR issued by CIBC. It gives investors fractional exposure to strategy shares and includes currency hedging. It does not use covered calls or fund-level leverage, so we'll use it as the baseline. MSTY is the regular income version from Harvest. It owns strategy shares and writes covered calls on up to about 50% of the position. But it does not use leverage. MSTE is the enhanced version with 25% leverage. Now let's look at the price returns. MSTR fell about 68.9%. MSTY fell about 74.3%. And MSTE fell about 83.44%. Strategy itself had already lost close to 70%. But even the unleveraged covered call fund, MSTY, fell more on a price basis. Again, the reason is that the decline was not a straight line. Strategy had several strong rebounds along the way. MSTY took most of the losses when the shares fell. But during the rebounds, its covered calls limited part of the recovery. MSTE had the same covered call problem plus leverage. Now let's briefly include the cash distributions without reinvesting them. MSTR was down about 68.9%. MSTE was down about 66.47%. And MSTY was down about 58.02%. But just like before, this mainly shows the benefit of taking cash out of a falling market. So the more useful comparison is total return with every distribution reinvested. On that basis, MSTR lost about 68.9%. MSTY lost about 64.07%. And MSTE lost about 74.58%. The pattern is almost identical to the Bitcoin comparison. The regular, unleveraged MSTY did provide some protection. It beat MSTR by almost 5 percentage points. But after 25% leverage was added, that advantage disappeared. MSTE performed almost 6 percentage points worse than MSTR. And it fell more than 10 percentage points behind the unleveraged MSTY. So in a deep bear market, the losses from leverage can completely wipe out the protection provided by option premiums. So what can we learn from these two examples? A regular covered call strategy may soften the loss during a volatile bear market, but adding 25% leverage changes the risk. Leverage makes the decline larger. Covered calls may still limit the rebound. And if the option premiums cannot cover the extra losses and financing costs, the fund can lose its bear market advantage. These funds still have short track records, so one period cannot tell us how they'll behave in every bear market. We need more samples to validate. But these two examples give us a general idea what may possibly happen in a bear market. I am more curious to see how they behave when crypto assets recover. And this does not mean investors should avoid lightly leveraged covered call ETFs completely. Bull markets usually last longer than bear markets, and modest leverage can help these funds participate more fully when prices are rising. But one thing should be clear. Option premiums are not free money, and a high distribution does not mean low risk. Before buying any products, make sure you know whether it uses leverage, how much of the portfolio is covered by call options, and what could happen during a major decline. If you think this video is useful, please like, comment, and subscribe. Thank you for watching. I'll see you in the next video.